Thank you for joining us today for our September members webinar. My name is Jolene Olson. If you have any questions regarding your Tech Charts membership, you can reach me via the Contact Us link that's at the top of the website. As a reminder, all of our past member webinars are available on the member site. Please see your screen to see where you can find those. I hope you enjoyed this webinar, and here's Axel.
Thanks, Jolene. Thanks, everyone, for joining the Tech Charts members. This is our member webinar, quarterly member webinar, and today is my birthday, so I'm happy to share my birthday with our Tech Charts members.
Happy birthday, Axel!
Thank you very much. On a nice webinar. So hopefully it will be an interesting webinar for all of us. Today there are several topics that we will be covering. Some of them are going to be important chart pattern developments that are currently ongoing in the global equity markets. And then we will start looking at chart pattern reliabilities, some of the numbers that we have collected over the past few years. And then we're gonna be looking at some ideas in terms of trading tactics. Even though we don't touch the trading tactics side because we're getting a lot of questions on this, I wanted to give some ideas of what we can expect in terms of trading tactics and how we can combine it with the classical charting principles. So let's start. Okay, so Tech Charts members who are reading our global equity markets reports are familiar with some of the chart pattern developments in the global equity market space. The first one that I want to look at is the Chinese equity market. Okay, so Fed is easing, European Central Bank is easing, Fed is discussing even possibility of QE4. So all those things, and when we look at the global equity markets charts, we're at critical resistances that if we break out can bring some positive momentum to the global equities. Why is this important? Because when we launched the Tech Charts membership service, it was mid-2017 and the global equities were in a strong uptrend. And then in 2018, mid-2018, we started going into a choppy trading environment. Lots of volatility up and down, but there was not much trends like we have seen in 2017. So we have seen quite a few failed breakouts. Now, if we are entering possibly into another strong trend period, we will probably see more and more chart pattern breakouts reaching immediately to their chart pattern price targets. We like to see trend periods for chart pattern breakouts to resume to their price targets. So when we look at, for example, the Chinese equity market, we're seeing a massive multi-year long symmetrical triangle, and inside that symmetrical triangle, we are right at the edge of that upper boundary, forming another symmetrical triangle above the long-term moving average. Now, Tech Charts members know now that some of the things that I look for is a well-defined 2 months to 24 months classical chart patterns. When I say well-defined, clearly defined chart pattern boundaries that have several touch points. The second thing I look for is several times test of the chart pattern boundary. So 2, 3, maybe even 4th test, and then the breakout takes place is better than 2 times test. The reason for that is I want to see a lot of energy being built in that chart pattern, and then the breakout takes place. This results in a surge in volatility and the continuation of the trend. Preferably a breakout from horizontal boundary. That doesn't mean that we rule out the symmetrical triangles or chart patterns with diagonal boundaries. No, but I like to favor the chart patterns with horizontal boundaries if we have more of those. And breakouts taking place above the 200-day moving average and breakdowns taking place below the 200-day moving average. So just to give an example here, this small rectangle here in the last quarter of 2014 broke out on the upside, and this consolidation was taking above the long-term moving average. Here, another symmetrical triangle that formed was actually above the long-term moving average, and this increased the momentum on the upside when the breakout took place. Now we're consolidating in another symmetrical triangle above the long-term average. Now you can see that every time we come back, we're finding above the long-term moving at the moving average, and a little bit more pullback and a possible breakout can take us to new high grounds. The next chart is, I don't know maybe how many weeks or months we have been following these two global benchmarks, is the European equities. Now, when we see two charts like this, it's very difficult to be bearish, because what we are seeing is, for example, on the Euro Stoxx 600 index, which has more UK companies in it, the 400 resistance is clear, and we haven't reached that level. And right below that, we are forming this symmetrical triangle that now we're testing the upper boundary of it. The upper boundary of it and the 400 is at the same level. Now, if you look at the chart on the left-hand side, this is Euro Stoxx 50, which has more European index components than the UK FTSE components. And we can see a downward sloping trend line. But again, even that downward sloping trend line is being tested several times, and looks like this symmetrical triangle wants to break out on the upside. The breakout from this will also clear the downward sloping trend line. The downward sloping trend line is a multi-decade downtrend. So the breakout should be very strong and can easily result in a nice uptrend from here. So another global equity benchmark, similar to Chinese equities, testing critical resistance. From my previous reports, members know that I'm looking at these two charts. One of them is the monthly scale, the other one is a weekly scale. Both show the same message, 3-year long rectangle, and inside that rectangle we have this perfect head and shoulder continuation taking place that can act as a launching pattern. So a shorter term chart pattern completing a longer term chart pattern is something that we look for, because there are two positive signals coming. One of them is the larger scale chart pattern completing. The other one is the short term at the same level. So what we are seeing here is 1045 levels is being tested several times, and a breakout can easily result in a nice steady uptrend towards the rectangle price target 1270. So this is Denmark's OMX 20 index. So if we look at European indices, one of them was SMI that already broke out on the upside to historical highs. The other one might be pending for a breakout to all-time highs again, which is Denmark. This one is something that we follow every week. Three major benchmarks we're following: the iShares MSCI All Country World Index ETF as a performance measurement for the global equities. The other one is the emerging market equity ETF, which is the EEM, listed on the New York Stock Exchange. The other one is the Frontier Market 100 Index ETF. Those are basically giving us the big picture of different pockets of research universe, so frontier markets, emerging markets, and the global equities. What we're seeing here is, because we will be discussing in the reliable chart patterns, the rectangle, we're seeing a nice multi-month long rectangle forming here, right below the 74.8 resistance. So the lower boundary is at 70, 74.8 is the upper boundary, and today the market opened positive, so we might be challenging the upper boundary once again. If this thing completes on the upside, the short-term rectangle, it can also complete a possible head and shoulder continuation. Both chart patterns breaking out at the same time can give us a nice steady uptrend towards the price target. So this is another chart that we have on our watch list, and breakouts on all of those will be very positive for global equities, and all the charts are at the critical resistances. This was another chart that we have discussed. And I have featured the ETF of the Canada S&P TSX 60 index. Again, in the rectangles chart pattern reliability, we will be discussing the rectangle. And this was a 4-month long rectangle. You can see several tests of the upper boundary completed on the upside this week. It was on the watch list. And the chart on the right-hand side is Canada S&P TSX Composite Index. So it's a larger universe of stocks. But when you look at the Canada S&P TSX 60 Index, similar to the ETF, it is also breaking out to all-time highs. Similar to the broad index, composite index, it is also breaking out to all-time highs. So 16.6 level is breached on the upside this week. Still the week hasn't completed yet, but this is the bigger picture we are seeing right now. 16,000, the lower boundary, 16.6 upper boundary, 17.4 is the price target. Again, if you look at the moving average, where this consolidation took place above the moving average, last test found support at the moving average, and the momentum started from there. Here, the ETF found support above the 200-day moving average. One question is that on the daily chart, what kind of moving average I'm using? The 200-day moving average. When we switch to a weekly scaled price chart, that is equivalent to a 40-week moving average. 5 days trading per week gives us the 200-day. With the cryptos, there is 7 days trading. So the 200-day would be 365 days moving average, and the other one would be 52-week average. But with equities, because we have 5 days trading, the equivalent is 40 and 200. Now let's discuss a little bit about chart patterns and their reliabilities. Now, TechCharts members know that very short-term chart patterns, or mostly diagonal chart patterns, or derivatives of major chart patterns are not covered. I'm focusing on very select, widely followed, widely known classical chart patterns. For example, I'm not covering wedges. Pennants and flags, I'm not covering. Diamond chart patterns that are very rare, I'm not covering on the TechCharts website. What I'm looking at basically are those chart patterns when it is completed will give a position trader a good opportunity to get on board on the weekly scale price charts that would generate a couple of months length of trend on the upside or on the downside. So from those chart patterns, I have picked basically head and shoulder bottom, rectangle, descending triangle, head and shoulder continuation, head and shoulder top, symmetrical triangle, ascending triangle, and cup with handle. Since 2017 May, there has been several chart patterns that were featured on the breakout section of the website and also in the reports. Now, obviously, there is the bias of the analyst when selecting classical chart patterns, because this is a manual process. The universe is completely different from a different analyst's universe. Some traders and investors are looking in South African equities, or some are looking at UK equities. Some are only trading US equities, NASDAQ. What I'm looking at is emerging markets, frontier markets, and global equities, developed market equities, so that the universe is a little bit wider. And from those, I'm picking what I am able to pick. Sometimes the manual process misses some opportunities, and this is totally normal. Because what I'm trying to do here is basically to give members a perspective on how to identify those classical chart patterns. What qualifies as a rectangle? What qualifies as a descending triangle? What is the message of a descending triangle? And when it forms at the top, why should it form as a reversal? Or an ascending triangle in the middle of an uptrend, why should it appear? Why should it form as a continuation chart pattern? So those are the things basically that I want to drill to Tech Charts members. And you would know from previous reports and the coverage that we are not touching on trading tactics. Now, over the past 2 years, we had several occasions of classical chart pattern breakouts, and when we put the numbers together, we see that rectangles, again, this is due to my bias because I like to find rectangles, or the rectangles are easier to identify on price charts, were the most covered in the global equity markets report. Out of those, 110 reached their price target. This gave us a 64.3% success rate on the rectangles. We also talk about a chart pattern negation level, which I will discuss in the following slides. But head and shoulder bottom, because it has to appear at the bottom of a market, it has to come after a downtrend. So from May 2017 till end of 2017, the markets were going upwards. So the head and shoulder bottoms mainly appeared at the bottom of 2018 market reversal. So we have seen 25 occurrences. Out of them, 18 reached their chart pattern price target, 72%. Head and shoulder bottom was really successful. And then the third one came descending triangle. Out of 25 occurrences, 16 of them reached its chart pattern price target. Now, these numbers can be totally different for different traders, investors who are looking at completely different universes, markets, exchanges, instruments, and time frames. Now, those chart pattern breakouts took place on weekly scale price charts. If you're looking at daily scale price charts, you will see a different picture. But these are the sample size we have, and we're going to be looking at what differentiated those chart patterns at different market turning points. Now, we're going to start with the head and shoulder bottom. For new members, I want to stress the importance of head and shoulder bottom. It's one of the widely followed and widely known chart pattern. The left shoulder forms after a downtrend, and then the head forms at a lower low. The question that I get usually is, why do you future head and shoulder bottoms that has a horizontal neckline? Can't we draw a downward sloping neckline or an upward sloping neckline? Totally possible, and those chart patterns are valid as well. Those head and shoulder bottoms are valid as well. The reason I'm drawing or trying to future the horizontal necklines is because when there is a breakout, we know that that horizontal boundary is taken out. We don't see any other resistance that would stop the price at a higher level. So when it is breaking out, it's taking out all the minor highs at the same time. The right shoulder forms at a higher level than the head. And you will see in my reports that most of the time I like to see symmetry between the left shoulder and the right shoulder, both in price and time. So the width of the left shoulder, the width of the right shoulder are usually symmetric. So what I call those are textbook head and shoulder bottoms. And then the breakout takes place. The price target is calculated by taking the width of the chart pattern from the head to the neckline and then adding it to the breakout point. That gives us the price target. But you will see from the charts, or you have seen so far, that chart pattern price targets should be used as a guideline. That means price can exceed the chart pattern price target or fall short of the price target. So always you need another tool to protect yourself, the position, from going into loss or going into the other direction of the trade. So you shouldn't depend on the price target, that it has to meet the price target. It is not the case. Sometimes it exceeds, so you can have a bigger gain, or sometimes it falls short. It falls short of the price target. Here is one good example. So this was a 9-month long head and shoulder bottom. First of all, we should know where we are looking for those type of chart patterns. It has to come after a decline, after a downtrend, after a lengthy downtrend if possible. If we're looking for a head and shoulder bottom here, that's the wrong place to look for. If we're looking for a head and shoulder bottom here, that's the right place, because it has been a steady downtrend. The left shoulder formed, head, right shoulder, there is symmetry, both in time and price. And the breakout not only completed the head and shoulder bottom, but also breached a downward sloping trend line. So the idea of head and shoulder bottom is to reverse an existing trend. The only way that it can reverse an existing downtrend is if there is a downtrend. And one way to identify a downtrend is by clearly drawing a downward sloping trend line. And this qualifies as a clear downtrend, because when we connect these 2 points, actually this point was almost touching that. When we connect these 2 points and extend it to the right side, we see that the minor high for the right shoulder actually touched that level. And then when we pulled back, the reversal here, this candlestick, was actually another week of resistance. Only after that week we have seen a breach of that boundary, breach of that trend line, and then a pullback came. And this week was the week that we have actually realized that it is picking up, the breakout is going to take place, and the upward momentum is picking up. This was the week that we have received the breakout confirmation. Now you will remember from the reports that we need, while reporting those breakouts, we need a guideline, quotation, guideline. This is not a rule. It can be different for each trader or investor. And it falls under the trading tactic. We're following the Edwards and Magee 3% breakout guideline, breakout confirmation guideline. So the price needs to close above the chart pattern boundary by 3% margin on a daily closing basis for it to be confirmed as a breakout. Now, some traders might be more aggressive and want to get in faster, and they might use 1% breakout guideline. That's totally fine. Again, this will fall under trading tactic. What I want to stress here is the identification of this chart pattern and where it appears. Is it the right place to look for such patterns? What is the potential of such chart pattern going forward? Any other trading tactic around that will depend on the trader or investor's risk profile. Now you can see that after the breakout, we have seen a slight pullback, which was almost nothing, and then the continuation reached the price target. The second chart here, left shoulder, head. Now sometimes the head can be complex, which was similar to this, but that doesn't change the structure, or that doesn't change the main idea of the reversal. It can take longer. And the right shoulder, for example, took the form of a rectangle. So this was a perfect rectangle. If you wanted to trade this rectangle, you could have only traded the rectangle, which was clearly visible on the price chart. The breakout took place at the same level with the head and shoulder bottom, 17-month long head and shoulder bottom, immediately rallied to its price target. First, it found resistance. It reached the rectangle price target. So probably those people who were trading the rectangles took their profits. The first resistance came from there, and then the price took off and reached its price target. The third one, again, you see the downtrend, 4-year-long downtrend, being reversed with a 9-month long head and shoulder bottom. the breakout takes place. First, the breakout took place above the trend line. You can see several points touching. The minor high of the right shoulder, again finding resistance. So when we find resistance there and pull back, we are more confident that this trend line actually exists. So when that trend line is breaking out, we are more aware of the possibility of head and shoulder bottom taking place. If the breakout here takes place and then price falls back below the trend line, that will raise some questions about the validity of this reversal formation. So the reversal formation is actually reversing a downtrend, and that reversal is taking place by clearing several technical levels. One of them is a basic trend line, a downward trend line. Then the breakout confirmation came at 412, slight pullback, rally, pullback, reaching the price target. Next chart is another example of a head and shoulder bottom. This was a 6-month long head and shoulder bottom. You can see that all these reversal chart patterns took place after we peaked in 2007, end of 2017, global equities peaked. 2018 was a down year, a choppy down year, and then the reversal formations took place. Here in the mid 2017 or the second half of 2017, a similar breakout took place above the long-term average. This time this was a downward trend channel that broke out on the upside. But if I am going to look at a price chart, this versus this, I'm more excited about the head and shoulder bottom that's taking place than the channel. So the horizontal boundary broke out on the upside. 417 was the level that we got the confirmation. Again, for some people this might be too far compared to 4.5. A 1% breakout guideline can be applied. A pullback, a dip below the chart pattern boundary, and then a quick recovery and rallying to the price target. Next chart is another head and shoulder bottom, similar symmetry between the left shoulder head and the right shoulder. Now, chart pattern negation level. Let me talk a little bit about the chart pattern negation level. What is this? Is this the stop loss? No, it is not a stop loss. We need to have a level to decide that if this chart pattern is not a head and shoulder bottom reversal, what point do we decide it is not? That is the low of the right shoulder. Now with head and shoulder bottoms, it's more clear because we know that it's the lowest point of the right shoulder with head and shoulder bottom. In fact, if we get a failure, it's even tradable because it acts as a head and shoulder bottom failure and we extend the price target. There are several educational videos on the website. With rectangles, for example, it's a little bit more subjective because I try to find a level inside the chart pattern boundary, a minor low, that when we fall below that, the rectangle is morphing into something else. With ascending triangles and descending triangles, again, I try to find a level inside the chart pattern, a minor high or minor low, which is clearly visible, that once we fall below that or above, breach above that, the chart pattern is no more an ascending or descending triangle. As long as we remain above those or below those levels, I continue to view the developing chart pattern as the first identified chart pattern. So here the breakout confirmation, a couple of weeks of sideways consolidation and then reaching the price target. Hot Bay Minerals 2019. Again, you can see a downtrend. This is a daily scale chart. So you can see that both on the daily and on the weekly, the same principles apply. What are those? A downward trend needs to be reversed. A clear trend line can be drawn. The breakout preferably takes place above the long-term moving average, which is the case. So the breakout is taking place and the confirmation is 562, slight pullback, and then continuation to the price target. Chart pattern negation 4.4, the lowest point of the right shoulder. Now a couple of failures. Head and shoulder bottom, perfect, symmetry, horizontal boundary, horizontal neckline. Does that mean that they're not going to fail? Of course they're going to fail. Each chart pattern can fail and price can fall below the chart pattern boundary. These are possible. Even the best looking head and shoulder bottom or any other classical chart pattern, a textbook classical chart pattern, can fail. Now, even though we were breaking above the downward trend, the breakout took place, and then the pullback to the neckline. The next recovery, the next rebound, failed to reach its chart pattern price target and fell back below the neckline and went and touched the chart pattern negation level. Chart pattern negation level, again, it's not a stop loss, but for some people it can be applied as a stop loss. So this was a failure, and we can see that almost there is no difference between a successful breakout and a failed breakout. Both of them are clearly breaching their necklines, and some are reaching their price targets, some are failing. Here is another chart pattern, a clear head and shoulder bottom. The downtrend again was clear on the price chart. Left shoulder, head, right shoulder, neckline, horizontal. The breakout takes place, and then following the breakout, immediate pullback to the neckline, and then failure to hold above the neckline and going and testing the lowest point of the right shoulder. Now, one thing that we might see between those failures and successful breakouts is the successful ones more often do not pull back that much to the chart pattern boundary. So most of the time after the breakout, the balance takes place around the breakout level, around the breakout confirmation, or that weekly close level. If we want to give one example here, the breakout takes place, the balance takes place above the moving average and very close to the confirmation levels. So the defense takes place at a higher level, versus with the failures, it immediately falls back to the chart pattern boundary and fails to rebound and then falls back again below the chart pattern boundary. This is something that I have examined frequently with successful breakouts and failed breakouts. That is why we have discussed several times that the best breakouts are the ones that break out and rally immediately after the breakout. Now, question is, how do we manage failed breakouts? How do we know beforehand if it is going to be a failed breakout or it is not going to be a breakout? We cannot know. What we know is the signaling. We know the signaling. We know that this is a head and shoulder bottom, and sometimes market conditions change and those head and shoulder bottoms fail. Sometimes several head and shoulder bottoms break out at the same time and rally to their price targets. Can we also know what market conditions were? We might have an idea. Like, for example, in the second half of 2017, we know that global equity is in a steady uptrend, and we know that all kinds of bullish continuation chart patterns have a tendency to complete on the upside and reach their price targets. Whereas in the last quarter of 2018, after a steady downtrend, if the markets are forming a bottom, we are likely to see head and shoulder bottoms, and those are likely to be successful. This is one of them, for example. Now, I have discussed in one of our educational videos, you will see on our website, the ATR-based trailing stop loss. Now, there are several things that are common for all of us. Chart pattern identification is universal. It is our common denominator. An ascending triangle, a rectangle, or a head and shoulder bottom is identified in a similar way. It has its rules. Descending triangle, ascending triangle, the implications of it. However, everything else regarding taking advantage of chart pattern opportunity is personalized. It is trading tactics. Nothing is a rule at this point. It will be different for each trader or investor. What falls under trading tactic? Entry with a breakout confirmation. Should you take 2%, 3%, 1%, 0.5% with futures and FX? Sometimes I future ETFs of bonds. Those are not as volatile as equities. So 0.5% I sometimes put as the breakout confirmation guideline. These are all subjective. Exit at price target. Should we exit at the price target? Should we carry the position with a trailing stop? These are all trading tactics that falls under trading tactics and can be different for each trader investor. Position sizing, risking a percent of account, equally weighted positions, etc. All those are trading tactics. What falls under rules, which is what I'm basically focusing on, and I want to drill this by being more and more selective in the type of chart patterns that we're focusing and giving a perspective on where to look for these chart patterns and also touch on their reliability. What falls under rules? Identification of a chart pattern, qualification of a trend above the 200-day, below the 200-day, calculation of a price target. These are rules. More subjective, chart pattern negation level. Now, let's touch a little bit to the trading tactic and see what we can expect from both successful chart pattern completions and failed chart pattern completions with one indicator, with one tool. You can have different tools, different ways of approaching the market. I'm going to touch on the ATR-based trailing stop loss here. We have an educational video as well. You can study it there. Now let's take the example of Hod Bay Minerals, and we can see that the neckline at 5.4, the breakout confirmation came at 5.62. I'm always discussing on Twitter, on other platforms, when people ask me about where do you place your stop loss? Well, stop losses should be placed below the chart pattern boundary. How wide will depend on your position size, your risk profile and size of your account, etc. Many other factors. But let's say that the minor low somewhere below the chart pattern boundary we place as 5.2. Now this can be different. You can place 5.3. You can place 5.35. The tighter you place, the more aggressive you're becoming, basically, and the potential of the reward is increasing on the upside, but also you're increasing the chances of getting stopped out when the price falls below the chart pattern boundary. So you have to always leave some room, but we're taking 5.2 here for just to see what kind of potentials we can get. 5.62, 5.2 distance will be your risk in this case, and the reward at 1 to 1 will be here, 1 to 2 will be here, 1 to 3 will be here. Trailing stop loss is something that trails the price as the price goes up. As the price goes down, it starts going flat. So it never goes down. It always goes up and it always remains flat. when the price starts coming down. So you can see that it's trailing the price during this pullback and then the continuation. Now the price target 7.15 in this case covered 1 to 3 and a little bit more on the upside. So what you have risked, the gain was 3 times the risk in the beginning. Next one is one of the failed chart patterns, the silver equity that took place in 2018. If you look, for example, here, the neckline was at 273. This is the daily scale price chart. The breakout took place. The breakout confirmation is at 296. That is why I'm always saying that the 3% guideline can be different for each trader or investor. It can be tighter, it can be wider. So you can adjust those, you can tweak it according to your needs. Now, if we place the ATR three times the 10 period ATR at 260, it will trail the price during this pullback without going above the neckline. So this is a pullback to the neckline. And then during this attempt, it will start going up. It will start going up again. And during this pullback, it will hit the trailing ATR and you will get stopped out. Now 296 was your entry and you're getting stopped somewhere around 2.9. Whereas when you look at the chart pattern negation level, it's far below that level. Now, chart pattern negation level is a rule that will change the head and shoulder bottom, but the ATR is a trading tactic that you can apply and change change how this chart pattern can work for you. Let's look at a little bit rectangles now, and we have the same study on the rectangles. There are 4 types of rectangles. One of them is a bullish continuation, bearish continuation, rectangle as a bottom bottom reversal, rectangle as a top reversal. Here, one of the perfect rectangles, I would say, a 6-month-long rectangle taking place. What I like the most is after several tests of chart pattern boundary, you see this price sticking to the chart pattern boundary, getting prepared for a breakout. And when the breakout takes place, the momentum is really strong and takes it to the price target. Now, again, according to breakout confirmation 3%, 2,845 level was the confirmation. Price target was met after a slight pullback, filling the gap and reaching the price target. The next price chart is another rectangle taking place, the breakout taking place above the 200-day moving average. This is something that we're always looking for. Bullish continuations, bullish chart patterns should take place, breakouts take place above the moving average. So 660 was the resistance, breakout took place. In a week, we reached the chart pattern price target. Now, the best breakouts, as I always say, are the ones that break out and immediately reach their price targets. Here's another example of those type of breakouts. 8-month-long rectangle, 1, 2, 3, 4, 5 touch points to the chart pattern boundary. Same thing applies to the lower boundary. So it's when you look at this weekly chart, it's impossible to miss on your weekly scale price chart. For our new members, I want to mention how to start looking at a price chart. The way I follow the price charts is on the weekly scale price charts, I load 5 years of data on my price chart on weekly scale with candlesticks, white background. And on the daily scale, 1 year of price data on candlesticks. So this gives you basically the same type of price charts. What do I mean by that? Approximately 250 candle bars you're seeing on your screen, no matter what. Is it a weekly scale? Is it a daily scale? So that when you see a 40 candle stick chart pattern that is forming on your price chart, it has the same significance as another 40 candlestick price chart. Or if you see a 10 candlestick price chart, it has less significance on the daily scale or on the weekly scale. So that's how you compare and contrast, basically apple to apple comparisons. Here, this was a perfect breakout that took place and reached its chart pattern price target in a few weeks. The next chart pattern, so we are in a clear uptrend, and in this uptrend, we're forming a nice sideways consolidation that had several tests of chart pattern boundary, both on the downside and on the upside. The breakout takes place, and the rally takes us to the chart pattern price target. So clear bullish continuation. Look at the time period that it's taking place in the second half of last quarter of 2017 when the markets were in a steady uptrend. So in a steady uptrend, bullish continuation chart patterns have a tendency to succeed, and we are likely to see more of those. After a steady downtrend, it is time to look for reversal chart patterns. These reversal chart patterns can take the form of head and shoulder bottom, ascending triangle as a bottom reversal, rectangle as a bottom reversal. Here's another perfect rectangle. So as I said, I always like to see several tests of chart pattern boundary. Like a ping pong ball, the price goes between the boundaries, and it clearly shows that there's a supply and demand in those around those levels. So when the breakout takes place, one side clearly wins by pushing the others to either cover their shorts or adding more momentum by new buyers coming into the breakout. Here the breakout takes place after 1 week of hesitation. In a few weeks, the price target is met. Chart patterns, rectangle chart pattern can act as a bearish continuation, but that has to come in a downtrend. So this chart, this price chart was from 2018, second half of 2018, when the markets were in a downtrend. So 2017 was good distribution phase. In the first quarter of 2017, we have seen breakdowns, and 2018 we have seen breakdowns, and now the time has come to look for bearish continuation chart patterns. What are those bearish continuation chart patterns? Descending triangle, rectangle as a bearish continuation, symmetrical triangle as a bearish continuation, and in this case it's a rectangle bearish continuation. The breakdown takes place and immediately takes us to the price target. Now this beginning of 2018 obviously was not the right time to look for a major reversal, but we cannot know. Some patterns will definitely fail until the market conditions dictate the existing trends. So this breakout, for example, in the beginning of 2018, when the global equities were turning around, was signaling an upward breakout. Immediately, the breakout failed below the chart pattern boundary, and this was the subjective identification of a chart pattern negation level that was met in the following months. Here is another example of a failed breakout in the second half of 2018. Again, it was a choppy market for global equities. So the breakout took place and it failed to reach its price target, immediately falling back below the chart pattern boundary. Here's another example of a rectangle bullish continuation that is failing in 2018, last quarter of 2018. The breakout takes place. After a few weeks of hesitation, the price falls back below the chart pattern boundary and goes and hits the chart pattern negation level that we have identified as the minor low at 165K. Now let's have the same exercise of how the trailing stop loss behaves in those type of market conditions on rectangles. The breakout confirmation, Edwards and McGee guideline 3%, 210.35. The weekly scale is on the left hand side. So this is the week of confirmation. This is the confirmation day. So the day of the confirmation, if you place a stop loss tighter than the chart pattern negation, it will increase your potential on the upside, and the price target will contain a risk reward of 3. The tighter you place your stop loss, the higher the reward will be, but that will increase the chances of getting stopped out in an adverse movement. So you have to give some room for the price to actually fluctuate around the chart pattern boundary. What happened with this one is after reaching 1.5 risk reward according to these levels of stop loss placement, the price reversed and hit the trailing stop loss, which was above your entry level. So this acted as a good protection mechanism for this failed attempt. Another way to use those trailing stop losses is if you wanted to move slowly and you have a longer term horizon, longer term perspective, is to use it on weekly scale price charts. For example, here we have the Vitrolife that is breaking out of a 15-month-long rectangle. 142.5 was the level of was the upper boundary. The breakout took place. Confirmation was at this level. So on the weekly scale, we have to place a stop loss below the chart pattern boundary. I took 138 levels. Is there any reason? I tried to go below the minor high here as a protective measure. This is your protective stop, basically. So during this consolidation, your trailing stop loss didn't move at all. And when the price started moving up once again, then the trailing stop loss started moving higher, and this price action took you well above risk reward of 3 and reaching chart pattern price target. So this is another way to use the trailing stop on weekly scale price charts. Now, trailing stop loss is just one example of a trading tactic. You can use moving averages, you can use the candle bars as a exit criteria, or trailing bars. There are different methods to use, but this is just one example that I wanted to show how you can combine the chart pattern breakouts, the signals that are being alerted as breakout alerts, with some kind of trailing stop loss or a protective measure to one, trail the price much higher than the price target, to be able to protect yourself on the downside if the chart pattern price target is not met and price fails to reach the chart pattern price target. Now we're going to look at descending triangle. Descending triangle, we have two types. One of them is when it forms after an advance, acts as a top reversal, which is on the left hand side. The other one is after a downtrend, it forms as a bearish continuation chart pattern, and both of them are bearish chart patterns. The reason they are bearish is their downward sloping trend line. This shows that every time the price rebounds from the same level, the sellers are more impatient to exit at a lower level. They don't wait for the previous high. They don't wait for the previous high here, and they sell it at an earlier peak here, eventually breaking down the horizontal boundary where the buyers stepped in every time to protect the price from going down. Eventually buyers give up and sellers are able to push the price much lower. So that's the dynamic behind descending triangle. When we see the descending triangle, we look for a breakdown below the horizontal boundary. Some of the examples, it has to come, as I said, a top reversal has to come after a steady advance. Now, another thing that we look for is that when the descending triangle forms, it shows distribution. That means the sellers are overcoming the buyers. And that means that a reversal is taking place, a reversal of the existing trend. And that confirmation can come when the breakdown takes place, a breakdown below the long-term average. So we plot the 200-day moving average again, and we want to see a breakdown that takes place below the long-term average, which is the case here, descending triangle, reaching its price target. Another example, this acted as a bearish continuation. Now, why do I say it as a bearish continuation? Because initially the trend was up. The breakdown took place that took us below the long-term average and much below the trend line, upward trend line. Pullback, down, another rebound, down, another rebound, and this time the breakdown took place below the long-term average. Now you can see that how the 200-day moving average acted as resistance. As it was acting as resistance, you become more confident that already a trend has reversed and the initial down move started. This has to be a continuation, a bearish continuation. Breakdown takes place, pullback, continuation. We're gonna study this as an example with the trailing stop loss in the next slides. So it will give you an idea of what you can expect from chart patterns that reach their price target without reaching the chart pattern negation level. This was a perfect descending triangle that acted as a continuation. So the initial trend was down and then multi-month long consolidation. You can see how perfect the horizontal boundary was. Even this week, we have seen a slight rebound and closing at the off the lows, but the next week was a decisive breakdown. And when the breakdown took place, it basically changed the whole structure, leading into a massive sell-off towards the chart pattern price target. Here's another perfect descending triangle that acted as a reversal. So the idea is the same here again. You can see a steady uptrend above the moving average. Every time the price is finding support, finding support, rebounding, and this time starting to penetrate the moving average more frequently. And now we know here that something has changed. It is not this period again. So this was basically in the first quarter of 2018, second half of 2018. So things are changing in the global equities. Horizontal boundary, several times tested, breaks down with a strong weekly bar. The daily confirmation came at 29.9K, slight pullback, and then reaching its chart pattern price target. Even this rebound found resistance at the long-term average and continued lower. Another descending triangle that acted as a reversal. So you can see here that our descending triangles started succeeding when we formed the top in 2018, okay? And our head and shoulder bottoms started succeeding when we started forming the bottoms in the beginning of 2019. And our rectangles were very strong and successful when we were going upwards in 2017. So it is now becoming more clear that depending on the market environment, the type of chart patterns that succeed and reach their price targets will matter. So it's like fishing. When you're fishing, you should know what kind of fish you're looking for and where you're searching for this fish. So descending triangle that's acting as a top reversal is coming after a steady advance, and we know that these chart patterns are acting as reversal. Here the breakdown takes place and takes us to the price target into early 2019, first quarter of 2019. Another descending triangle that acted as a top reversal. Now let's look at 2017 on this chart. It's a perfect example. First half of 2017, you see the symmetrical triangle taking place above the long-term average. The breakout takes place and a steady uptrend takes place after that. Bullish continuation above the moving average. bearish reversal below the moving average. So the trend filter is working perfect at this point. Now we don't force our analysis on any chart. If we see those type of patterns, if we see those type of confirmations, we get more excited about that chart. So that's why I always advise to look at as many charts as possible to find those type of perfect conditions. Like for example, being able to find a symmetrical triangle consolidating above the 200-day moving average can only happen if you're looking for so many charts at the same time. And obviously this will need a little bit of time, but it is worthwhile to go through different setups, to go through different chart patterns or different markets that are not correlated as well. So the breakdown takes place, pullback, continuation to the price target. Now here, I want to touch an interesting point because in the Richard Schabacher's and Edwards and McGee's books, there is a fine point that mentions about the weekly scale breakouts. We are looking for daily breakout confirmation. But I always stress that if at the end of that week, the candle is long and it's a strong weekly bar or it's a weak weekly bar, chances are higher that the breakout is strong or the breakdown is strong. Now this chart, even though during the week we got a breakdown confirmation, the close was almost at the highest level. And immediately the week after, the price reversed back into the chart pattern boundary. Now this is a clear warning signal that the breakdown has failed, and this actually can act as a buying opportunity for different type of trading strategies. Here we have another 4-month-long descending triangle on the daily scale. Breakdown takes place. It's a clear downtrend. We can easily expect this price to go down to the price target, but market conditions change. Beginning of 2019, some of the global equities started rallying, and this chart in Hong Kong reversed back above its chart pattern boundary and reached the chart pattern negation level. This is another failed attempt. Now, as I said, even the best looking descending triangle head and shoulder, but even the best looking classical chart pattern are likely to fail, so we have to always keep that in mind. This was a clear uptrend above the 200-day moving average. You can see the consistency in identifying those chart patterns. The more consistent you become, the higher the chances of success in the long run, because these chart patterns have a tendency to succeed in large sample sizes. If you look at the pullbacks, 200-day moving average finding support, 200-day moving average finding support, and then we see a distribution here, and the lower boundary of this chart pattern is overlapping with the upward trend line. The breakdown is taking place, but immediately the week after, the chart pattern boundary is breached on the upside. Now, if you go to your charts and look at this equity, you would see that this was the peak, and following that, the stock collapsed to 100 levels. So the implication of the descending triangle was actually right. It was actually showing us a distribution, a change of trend was taking place. It's just that during these couple of weeks, it was a challenging environment for any short position on the stock. But this didn't change the overall implication of descending triangle. Descending triangle was actually signaling a change here, a reversal. So, example, again applying the ATR, trailing stop loss. So this was the Spanish company, the bearish continuation chart pattern, descending triangle. You can see the lower boundary being tested. The breakdown takes place. Now this is the weekly scale, 6-month long descending triangle. Every time we found resistance, we fell down and the breakdown confirmation took place at 10.17. What we do is we place a protective stop above the chart pattern boundary in this case, which stays flat and then starts trailing down, and then during this, after reaching 1-to-1, the distance between this level and 10.17 extrapolated downwards is 1-to-1, which is around 9.5. After reaching that risk reward, the price shot up and it reached the trailing stop at the same level of entry. But the stock price didn't reach the chart pattern negation level. So even though your entry and exit was at the same level, you were still looking for an opportunity to get back in if the descending triangle was to resume. After the spike, price breached the chart pattern boundary and started coming down. Now I took the same level again as an entry point. For many, it could be a higher level. But I took the same level because we took the same level here as the 3% Edwards and McGee guideline. I'm taking 10.17 here, placing the 3 ATR stop loss at 10.8, again at the same level. This time you're capturing this downward move with the trailing stop loss following the price and giving us a 1.5 risk reward on this chart pattern completion. So what do we understand from this? We can say that a descending triangle that, even though reversed back inside the chart pattern boundary and didn't reach the chart pattern negation level, and this was considered a minor breach given the 6-month long descending triangle, still has a chance to succeed and reach its chart pattern price target, is the message of this chart. This is the end of the presentation. Now we can move to questions. Jolene?
Thank you, Axel. Lots of happy birthdays came in, so I wanted to say that first. Happy birthday from everyone.
Thank you so much.
You're welcome. Here's question number 1 coming to you now.
On triangle breakouts, how important do you feel it is to clear the last pivot point as opposed to buying the breakout immediately before entering a trade? I think it is very important. That's why I like to see those triangles that are a little bit more flat, that is between rectangle and symmetrical triangle. I like to see the minor highs being taken out at the same time we see a breakout from the triangle. If not, maybe waiting a little bit more until the minor highs are taken out. Could you please comment on the HUI or GDX graph? I think this is the gold ETFs. The gold ETFs broke out from symmetrical triangles, rallied, and now we're at a point on the weekly scale. It is still a minor pullback. I don't have the graph now, but I would say that from a weekly scale perspective, the trend is still upwards and still continuing. So you've seen here maybe the application of ATR trailing on the weekly scale. If you apply it, it should be still trailing the price fine. You have been using SSE 50 to analyze China. May I suggest including or start using A50? The reason is apparently the futures contracts trading on the SGX. Or is there a leveraged way to trade SSE 50 other than CFD? Okay, I will look into this, and I will try to see if there are any instruments to be able to take advantage of the breakout on the SSE 50. I know that there is an FXI ETF, but sometimes they don't look similar Okay, slide 2 is the moving average simple, exponential, or something else. All of my moving averages are exponential. This is some kind of a template that I have been following for the last 15-20 years. Just exponential moving average and logarithmic price scales. The reason for that is for those members who don't know the differences between the moving averages, is that, for example, the simple moving average will give equal weight to each data point. Exponential moving average will not give that much weight to will not give equal weight basically to each data point. There's a coefficient that applies for each data, and I feel like it is a more proper way of detecting the price movements. It's more responsive. Can you start posting the slides with the member webinar on the member site? It would be very helpful. Okay, the slides. Okay, I will do that. Yeah, we will find a way to post those slides on the member site as PDF. Head and shoulder bottom reversal. It looks like from the examples that the downtrend line would be breached, retested, and form the right shoulder and then break out. Question: would it be advisable to take position after right shoulder? It is possible. As I said, you can fine-tune those chart patterns according to your needs. Even partial position can be placed at different parts of the chart pattern completion. For example, the descending triangle that we have seen on the Spanish stock, as the descending triangle was forming, it has become clear that the 200-day moving average is acting as resistance. And the last time that it tests the upper boundary and reverses might be a point of entry for some people. So yes, it can be used as a different ways of entering and exiting. When a head and shoulder has a neckline that is slanted left or right, to which point do you trade? So from classical charting perspective, when a head and shoulder bottom, let's talk about, has a downward sloping neckline, when the head and shoulder bottom has an upward sloping neckline, this is more bullish than any other head and shoulder. But it is difficult to trade. Why? Because you do not know exactly the level that it is breaking out. That's why I like to see the horizontal necklines, and gives me a better feel of when the breakout is taking place. Why 3 times 10 period ATR? Is it from experience? Is this the best setting for Axel's time frame? Well, I haven't optimized it. It hasn't been tested. It's just a manually entered number. And I have seen that from my manual viewings of charts, this has worked well. And it doesn't for example, when the chart pattern is completed on the upside and you place it below the chart pattern boundary, it doesn't immediately move up. It takes its time. If you use 2 times the ATR, for example, it might be faster. If you use 4 times the ATR, it acts slow to catch up with the price, and it gives you more room. It is just from my experience. But it can change with different time frames. For example, if you're looking at a daily scale price chart, you want to capture long-term trends on the daily scale, you might use 4 times or 5 times the ATR. That's totally fine. You can play around with the ATR numbers and find the best fit. If not, if ATR is not your field, you can use moving averages. That's also a possibility. Broadening triangle. It's probably not worth taking a position, but when a flat top broadening triangle forms in the downtrend, is there a bias? Example, Canada government bond 2-year rate. Flat top broadening triangle formed from March in the middle of the downtrend. Well, if there is a horizontal boundary, irrespective of the chart pattern, if it is a broadening or a contracting, I would take that opportunity, because if there are several tests of that horizontal boundary, that means it is clearing a resistance. So the first technical analysis 101 is support and resistance. If there's a clear breakout, it is worth taking that opportunity. If, of course, you don't have any other good-looking charts out there that have a bias, like, for example, an ascending triangle or a bearish continuation chart pattern. How do you answer something like this? I never thought buying breakouts was a good way to trade. Takes so many buyers to get a stock through resistance. You don't want to be buying after that. Pullbacks after the breakout or ahead of a breakout only for me. That's totally fine. The question is, do you want to catch the stocks that rally immediately, or do you want to increase or limit the downside risk by going for the pullbacks? It's a totally a matter of preference, a matter of trading style. Now, sometimes breakout take place and doesn't give an opportunity. If you realize that those are few compared to the ones that pull back in your time frame, in your market, then it is worth waiting for the pullback, and it's totally fine, and it's in the books, and it says that a price chart, a chart pattern that completes, is likely to pull back to the breakout level. When a premature breakout happens and the stop is hit, if the breakout happens again, would you take the signal again? If yes, do you change the position size if the risk is lower this time? The example showed that it is possible to enter into another position in the direction of the breakout. Yes, if I don't have any other opportunity that is a fresh breakout, I would consider it. Position size, if the risk is lower, I'm not able to answer this, because each position size is the same for me. Each trade idea is positioned with the same size. Have you calculated which patterns tend to assume which roles, continuation versus reversal? Ascending, first of all, cup with handle is for sure a continuation. It is not a reversal. Cup with handle doesn't happen at the bottom or at the top. Head and shoulder continuation is a continuation. All the others can appear as a reversal or as a continuation. For example, descending triangle, as you can see from the examples that we went through, can appear as a reversal and a continuation. Same thing is for ascending triangle. Ascending triangle can form at the bottom as a bottom reversal and a continuation in the middle of an uptrend. Is there any suggestion other than using the correlation table which breakout signals to select from, because you highlight many and they all look pretty good? Okay, no, I don't think there is any other suggestion. Even that correlation table is looking at the 2-year weekly correlations, and you might actually run your daily correlations as a supporting tool. But if you don't have such access to data, I think the best option is the 2-year weekly that is in the reports, to get an idea if the stock is correlated. Okay, this is our last question. What does on a daily closing basis mean? Example, when saying that the 3% breakout confirmation has to happen on a daily closing basis. Yes, daily closing basis means the close of that day should be above the breakout confirmation level that we're mentioning. So we have the chart pattern boundary. We're calculating 3% of this level and moving it upward, and the close, the daily close, either it is Monday, Tuesday, Wednesday, or any day of the week, it has to be above this level. When it is above this level, we confirm this breakout as a completed chart pattern.
Thank you, Axel. That's all the questions we have.
Thanks, Jolene. Thanks, everyone, for joining. It was a pleasure, and hopefully we will see some nice trends in the near future in the global equities, and we will take advantage of those. Thanks for joining, everyone.
Thank you again, everyone, for joining us and for being a Tech Charts member. We really appreciate you. Again, if you have any questions that come up, feel free to email us directly, and we could get those answered for you. Axel is fantastic about answering emails, so send those questions in, save them for the next webinar, add to the bottom of the screen on the member site. So there's many ways to contact us, and we really want to be here to help you and to get all your questions answered. And we hope you have a wonderful rest of your day. Thank you very much, everyone.